This is the Moneymakers. I'm Bruce Whitfield. This evening, event-driven value investing. Sell in May and go away, the old folk will tell you. Well, if you've done that in recent years, you probably would have lost money. Are events really worth investing around? Whether the Fed's going to raise interest rates, lower interest rates, or keep them the same, whether the petrol price in South Africa is going up or down, whether President Jacob Zuma is going to be the next president of the country, whether he's going to push Nkosazana Dlamini Zuma into place. There's just too many moving parts, frankly, to worry about individual events, or not, as the case might be. Nic Norman-Smith is with Lentus Asset Management and the independent investment analyst Chris Gilmour in studio with us this evening as well. Events, big events. I mean, World War II was kind of disruptive for markets, particularly the Japanese market. It wasn't particularly good for the German markets either, no doubt. And of course, Chris Gilmour will remember this, but the days of austerity in Britain after World War II weren't great either. That's an event. Did we worry about anything else in the world, frankly, Nic Norman-Smith, when it comes to these peripheral little data points or anything else?
Well, to the extent that they drive market prices way out of sync, Bruce. So, excuse me, a lot of people, you would have heard the cliche, markets hate uncertainty. Well, at Lentus, we rather say we love uncertainty, because what uncertainty does is it provides you the opportunity to buy assets when people are too scared. So if you realize early on that you know very little and the future is very uncertain, you can then either avoid investments or make investments when markets have gone way overboard, either on the positive or the negative, because the reality is nobody really knows what's happening. So do events give you the opportunity? Well, they do, if you believe that that event is front and center of everyone's minds and has driven market prices. Trying to predict what that event is and investing on that we don't think so.
Okay, I mean, and that's the risk of looking at events and trying to make decisions moment by moment based on events. Chris Gilmour, I mean, this whole notion of uncertainty and markets hating uncertainty, markets by their nature are uncertain because human beings are uncertain, politics is uncertain, economies are uncertain. Is there any period in modern history where we have had certainty?
No, I think it's our only constant. You've got uncertainty, and it's becoming more and more uncertain. And look, if you think about it, I mean, here we have technology coming to the fore in so many areas, changing things quite dramatically. You know, I saw something in the FT the other day. The last time they had coal, for example, providing as much to the national grid as it currently does, was in 1882. So things are changing. Technology is changing dramatically. But you know, just to endorse what Nic was saying, if you go, there's a wonderful graph that takes the all-share index and goes back to 1960. You can take it as far back as you want, but 1960 is a good place. And it just goes inexorably upwards. There are a few little blips there. 1987, that was an event. It seemed like the end of the world. I remember it vividly.
There was a 22% decline in the value of the JSE on one day. It was July, I think. 1987.
Yeah. I think it was October, in fact, 87.
Okay, could have been.
Yeah. And it lasted for about 4 months. And by February, March the next year, people were buying in their droves. It was quite incredible. And the same you can pretty much say there was another event in 89. There was another one in the late 90s when you had the emerging markets crisis. You had the global financial crisis. And all of them appear as nothing really more than blips. Having said that, we've kind of gone sideways for a while now in the market. So where on earth are we going? What events are going to catalyze a change in that? And one of the most important events in very recent times was the Trump presidency. I think so many people looked at that and they thought, oh, terrible, if this guy comes in, we are dead in the water. We want Hillary. She brings certainty, you know, much more of business as usual. And yet you got Trump. The market dived for, about 2-3 hours? And then bounced right back again.
They're calling it the Trump trade, but even markets are tired of the Trump trade now and are looking for some kind of fundamental basis upon which to base record levels for the S&P, record levels for the Dow. The JSE itself is a fraction away from record territory, and we're on the brink of downgrade destruction, Nic Norman-Smith. Now, what is an event worth basing an investment decision on then?
Well, I think you need to look around and see where markets are very certain about something. So markets have been certain over those periods of time. In the early 2000s, markets were certain that dot-com stocks could only go up. And not too long ago, markets were certain that Mediclinic and Life Healthcare could only go up because everybody needed to go to hospital, and those share prices have halved. So I think you need to look and find out where the market is very certain. And one of those areas is the oil market. The market is very certain that oil is dead, just as certain as it was when that oil prices at 100 were going to 150, the market's now pretty certain that oil prices are going to stay at 50.
So are you certain that now is the time to buy Sasol?
Well, we don't know what the future holds, but what the market is doing is it's pricing in very, very bad news for Sasol, for oil drillers, for rig companies, for oil services companies, all based on the fact that Elon Musk is going to save the world, and the oil price is going to stay at 40, or will go back down to 40 and stay at 50 for the next 5 years. But if you look at the facts, this is the worst year. Last year was the worst year for the sourcing of new reserves since 1950. Demand for oil is still growing. Capital expenditure is through the floor for these oil companies.
So at some point, we start seeing stocks being depleted. We have to have those stocks renewed. As we need those stocks renewed, as OPEC continues to sort of hold the world in its grasp as much as it can, as a less important player than it was in the 70s, another big event, 1972, 73, Chris Gilmour. Oil reserves will then have to be tapped, and we'll see prices recover somewhat.
The world uses 3 to 5% of our reserves every year. They need to get replaced unless the oil price, without the oil price going up.
So if we're not looking at events, we're then looking at trends. Technology is changing the world. We don't know how it's going to change the world, but if you're going into an investment world and you say, I'm going to buy myself some newspaper companies, I'm going to buy myself gas guzzling motor manufacturers, I'm going to be buying myself similar sorts of companies that are perhaps a little bit more antiquated, you're headed for disaster. You've got to consider the environment in which you're in and not get caught up in the noise, as you talk about that graph from the 1960s showing these minuscule pullbacks over time that felt so catastrophic in the moment.
Yeah, no, you're right. And look, Bruce, as we mentioned a moment ago, I think technology is going to play a big part in here. I mean, Nic's alluded to this on the oil price. And, you know, I mean, you take something like Elon Musk with his motor company.
Tesla. Yes.
Tesla, that's the word I was looking for. It's now got a bigger market cap than GM. And Ford. You know, it's the biggest.
So the world is certain that Elon Musk is going to destroy General Motors.
Yeah.
And there's no such certainty.
Well, precisely. And he's now got wonderful ideas. He's going to carve tunnels under Los Angeles, you know, to get rid of all of the congestion that you have in the city. So there's plenty of good ideas around there. But, you know, they take time, and it's like turning a supertanker. And this perhaps a good analogy, oil, super tankers and the like. But you know, it does take time. And this kind of new technology, yes, I'm sure, in 20 or 30 years' time will be the norm. We'll have driverless cars, this type of thing. But you know, I think there's an awful lot of irrational exuberance built in to some of these stocks because it isn't going to happen overnight.
So it might happen. So we're not saying that it won't happen, but the odds are very poor. And that's the key. You want to be investing when the odds are in your favor, not when the odds are against you. So Musk might do it, but at that pricing level, he's got to do even better than that in order to make any money by buying.
We tend to overestimate the benefits of technology and innovation and the opportunities that they bring. We also overestimate the calamity of the industries that they promise to disrupt. Yeah, so how then, as investors with a 5-year time horizon, do we treat the noise?
I think Bill Gates said we overestimated in the short term and we underestimated in the long term. Now investors generally are investing often for the short term, and that's where those come in. So it's quite simple. To cut out the noise is if you have a fundamental basis for a valuation and you make sure that valuation is conservative and you put in a margin of safety and all these boring things that we hear over and over again, and you buy the stock when it's cheap and you sell it when it's expensive, and that's the hardest part, because it's kind of much easier to buy the stock when everyone's hating it and you ride it up, and then suddenly you start thinking, gee, I'm so smart. Now the market's realized what you've realized. Now to try and actually sell that asset before it does get up too high. And now those risks that weren't a risk when the share was much lower are now potentially going to come to bear. But in
an environment, Chris Gilmour, where asset prices are elevated, and I know our market has chugged sideways for the last 3 years or so in a band between, say, 50,000 and 55,000 on the all-share index, and there are lots of reasons: falling resources prices, recovering resources prices, downgrades, the threats of downgrades, political risk in South Africa. It's arguable, though, that 3 years ago 55,000 was too expensive. 55,000 today is far more far more appealing evaluation than it was 3 years ago.
Only if you have the earnings growth that will underpin that. And to follow on from what Nick was saying, yes, I think you get comfort from the fundamentals. Now, if the fundamentals are intact, then fine. You can live with these high valuations. But let me give you a classic example. If you take the food and drug retailers, you've now got stocks like Clicks, PEs of 30, Pick and Pay almost 25, ShopRite and one or two others, also on very, very elevated PEs. They've been driven up predominantly by foreign investors thinking, wow, this is fantastic, great, well-run companies, not taking anything away from that. But against a background where you've got the PMI, which came out the other day, collapsing to 44, where you've got new car sales diving 13% month on month, where you've got an economy that is really starting to contract badly. Are these kind of valuations justified? Probably not. So, there's a classic, or somewhat mundane example of, bring it back to the fundamentals. If you can justify these high valuations on the basis of fundamental earnings growth, and if you're looking at 10 to 12, 13%.
I need to wrap up. Sit in cash for 5 years, or buy the all-share index?
If you've got the stomach for it, buy the all-share index.
Nic Norman-Smith?
Buy components of the all-share index that are cheap.
Which ones are cheap?
The South African focused ones. So companies like Imperial.
But we're in a broken economy. It's the end of the world.
Yes, but stocks like Imperial and the resource stocks have priced that in, and to a certain extent, some of the banking stocks, something like a Remgro with a slightly more broad-based exposure, that's pricing in not quite Armageddon, but very bad news. Whereas those companies aren't. One of them is going to be right, one of them is going to be wrong. I'd rather be in the one that's cheap to have some protection if the world is bad. And if it's good, Clicks will probably stand still, and something like a Remgro will rally. So, heads I win a lot, tails I lose a little, and that's the kind of odds you want.
Nice guidance, gentlemen. Thank you very much. Nic Norman-Smith from Lentus Asset Management, and Chris Gilmour, the investment analyst, joining us this evening on the Moneymakers. I hope that helps you make sense of a turbulent world. Till next time, good night.